Greetings, this is Dr. Jeffrey Scott, and this is my weekend market update for September 18th, 2022. I have gone ahead and titled this one, Waiting on the Fed, but, realistically, waiting on a retest. Oh, what a bad week that was. Oh my God, did you see CPI? All could have been alternative titles. Again, this is for Sunday the 18th. It might come out earlier on Saturday night. And my email address for remarks, comments, questions is hgsi.gmail.com. Disclaimer, this is for education only. Anything I recommend should be considered in the spirit of education and not investment advice. I am a doctor, not a broker. I don't have Series 5, 7s, or any other things that I would need to have to legally give you investment advice. So this is not investment advice. Tools demonstrated are those that I use in my daily trading. I've paid for all the tools I will be using today, and no one pays me to say good things or bad things about their products. Trading involves risk, and you are solely responsible for any investment decisions you make. I just want to remind everybody that coming up in a few weeks is the Wealth 365 event. If you don't already have wealth charts, it is the time of year to buy it. You get the biggest discount. And if you have it, you'll learn how to use it greater, and especially on some of Rob Hoffman's marathon late sessions. I will be presenting once or twice, and like myself, many folks will be having special offers on their tools that they use in wealth charts. Hope to see you there, and I'll place it below the introductory comments on the YouTube channel. The other thing is, if you like these recordings, you have an opportunity to watch them every day. Imagine that. Because every day, early in the morning or the prior night, I record a 5 to 10 video of what I think is going on in the market and some long and shorts that I am watching. Again, I am not giving investment advice. This is purely education, and I give the background of why I'm looking at those particular trading vehicles. I've been talking about my Florida meeting. It is on. It is on. Now, the only thing I haven't defined, and I will decide over the next few days, is where I'm going to have it. I will either have it at the Palm Beach Gardens Hilton Garden Inn, which is where John Person has his meeting, or I'll have it at a property that's on the water in downtown West Palm. There's pros and cons to both. It's all about the availability and economics. Details will follow, but it's 2 days. I'll make you fat and happy, and you'll get copies of the presentation. We'll feature use of my favorite programs: Wealth Charts, HGSI, EdgeRater, Q-Tools, TradeStation, and Think or Swim. Some other details. If you want to come, I guess it's time to get binding. I'm going to limit it to 15 attendees at $1,000 per person, 2 days. Again, you'll get the sessions and all the meals. Now, $1,000, I do a lot of events where people charge a lot less money and a lot more money. To me, $500 a day is not about me making money. It's about me covering my costs. And boy, will you like the dinner I take you to on the first night. And I always get a lot of positive feedback after my meetings. If we look at the markets from last week, this is sort of the Monday through Friday performance, and to say it was a tough week is an understatement. I'll just go right here. When you have a 5% down week on the S&P 500, you know it was painful. And whether you're looking at larger cap NYSE and Dow down 4,144 or smaller caps that are down as much as 5.8, it was a very difficult week. Now, it was an interesting week because we shot up Monday morning, and then we had the CPI came out and the market rolled over. And Friday, we actually had a reversal intraday, which maybe will carry through some Monday and Tuesday. But I do think all sights have to be on the Fed statement and meeting. More to follow on that. Now, if you look at performance over the year, you could see that NASDAQ and Russell are down over 26%. The Spider is pretty much at bear market territory, again at 19.7, while the NYSE and Dow are down a little bit less. Now, the other thing to look at is over here is how much we're off the June lows. And you could see on the Dow, the low was set June 17th, we're 3.9%. If we go and look at the NASDAQ, Russell, and S&P, again, the 617 on the spiders, 616 on the others, and you could see we are a generous amount from 4% up to 10% off the lows. If my target is the June lows, that kind of gives you what I think the opportunity of further pullback is. And then we see whether we retest or not. If we look at the sectors, you could see here all the sectors are way off, or that were off on the week, not necessarily way off. But this is interesting how energy, even though it's down 15.9% on the year, if you look at how far it's from the 52-week low, which occurred in September of 2021, it's up 68%. Kind of interesting. Q-Edge tools, here we go. What do I learn here? I see that on the pie chart that 91% of sectors, 81% of industry, and 67% of stocks were down on Friday. Again, this was a massive improvement from earlier in the day. The only sector that was up in the Q1500, you have to know what you're measuring, was real estate. You could see we've shifted to the left, but we're not a lot of stocks in the last two buckets, which would be stocks below the lower Bollinger Band or near the lower band. And if we look at this over a period of time, you could see on 5 days, every sector, almost every industry, and 90% of the stocks were down over the past week. That should give you a sense of how rough of a market. Now, the warehouse view is I take all the stocks in the market and I look at them for earnings, relative strength, and group. If I combine each of those, it's called ERG. This was last week. We had a straight line up here between 0 and 10% up. Very positive week ending on the 9th. This was this week. Everything's below 0. So total reversion of what we saw the prior week. If I look at patterns, I don't see any patterns that help me. The NASDAQ, no Hindis, we wouldn't expect one. The weekly bongo, which is my long-term buy-sell signal, is red. That means it's a time not to be long, at least not with a lot of your money. You could see the number of stocks getting to 52-week lows is starting to grow. Clear weakness in the NASDAQ. Similar in the NYSE, the numbers growing of stocks near their lows, and we reverted to a bearish weekly bongo as well. The buckets, this is similar to what I showed you on the Q-Edge. You can see 84% of the stocks in the S&P 1500 are below their midline. That is bearish. What you want to get to is a number like this where 20% are below the bands, another 30% are at the lower band, and that's when you get a reversal. This is not yet in reversal territory if you think we have to reverse on Monday. Energy had a rough week. The only things showing positive were methanol, but you could see oil was down, heating oil was down, nat gas was even down, and nat gas in Europe was down as well, and uranium was down 7.23. Probably the strength of the dollar does not help that. If we look at metals, you could see again mostly negative on the weekly. Silver being a standout. Not sure if it's specific industrial uses. It's still got to be pressured by the high dollar. Platinum was also up. The dry bulk index, which I track routinely, moved up off its lows, but it's still very close to its 52-week lows. Interest rates clearly are driving a lot of the pain in this market. This is the 10-year, this is the 30, and you could see rates spiked on the week, and as rates spiked, the markets have turned over. Here is the Fed credit spread. When it's elevated, it means money is tight. I can tell you, as somebody out in the entrepreneurial world of medicine, I'm hearing from a lot of startups that money is tight. Why would you care about this? Because back here when it spiked at the end of 2018, the market sort of rolled over. So there's a reason why I track this. The other thing to look at is the yield curve. And the more inverted it gets, the more nervous I get. And I think it's just a sign that the short term, the rates are rising faster than the long term. Perhaps people are expecting eventually for rates to come down. But right now, that's not a great sign if you're out buying a house, for example. Overbought, oversold, stocks above the 200, stocks above the 40, both came down, neither of which are in a reversal zone. 13-week new high, new low. From top from bottom to top to bottom in 2 weeks, not yet at a clear-cut reversal zone. Economic news, the big star this week is going to be the Federal Reserve, and then we got some jobless claims and leading economic indicators on Thursday. You got to know this stuff, folks, because on Wednesday you expect something to happen in the market, and I think the odds are people are looking today at another 75 to 100 basis point increase. I think 75 the market may accept, 100 is going to scare people. Why? Because it would tell me that inflation's even worse than the numbers are telling us if the Fed's doing that. We look at earnings. This is the good news. Not a whole lot of earnings this week. And the big one, FedEx, already pre-announced, and that sunk the market overnight Thursday into Friday. Expected moves, let's just look at the S&P, what happened this week. Traded up on Monday. Horrible down day, fifth worst ever in the S&P 500. Sideways Tuesday, Wednesday and Thursday, and then another leg down Friday, but it closed back where it opened, and you got hammers on the E-minis, the NQs, the YMs, not quite on the TFs or RTYs. So that's actually good. VIX actually broke out above its expected move. Finally, the VIX is moving, and the dollar stayed within. So rough week. That's enough said. What are my thoughts? Markets started the week on a high note, quickly dissipated as markets digested the August CPI. The reaction both the stock and bond markets was brutal. As I mentioned, Tuesday's sell-off was the fifth largest in the S&P 500 history. Yield spiked, yield curve more inverted. Market sold off hard again Friday as it digested FedEx's warning. Ended the day on hammers. That might make the bulls feel happy. Key event this week is the Fed meeting. I remain concerned that we go lower with upcoming retest of the June lows potentially looming. Doesn't mean we have to go lower. It means since I think that's likely, I'm not putting a lot of my money at work right now. Cash is king. And then if we look at the Wealth Charts 365, just again to remind you, I'll have the link here for me in the YouTube invite. And lastly, reminding you about stocksanddocs.com. It's funny, I was reading something this week on one of the boards I participate in, and somebody was asking about are there good indicators that warn you of a looming market sell-off. And I sort of laughed because the one that I use is the Hindenburg-Omen. And we won't see one of these for a long time. But if you're looking for something that perhaps in 2020 might have gotten you out before the market rolled over, similar to this market, here's 2018 at the end of the year, 2018 at the beginning of the year, take a look at that Hindenburg-Omen. I'm not going to talk about it now because it's irrelevant. Now, let me show you how I do my analysis relatively quickly compared to the old days and try and get through a lot of information in the next 20 minutes, 30 minutes. I start with a wealth scanner by itself. Well, it's got Wealth Charts TV as well. Looking at my indices and looking for one thing, hot stocks. If you have a hot signal, then you are moving up or down. So you could see that this blue, which is the day trader, and I've got this set for quick movement, sold off hard a few days ago. And it got a hotness because of the degree of that sell-off. That's why it's got a flame. And it's a high yield, short high yield bonds got weaker. All right, I guess that means high yield bonds are getting better. This is a international real estate, and this is SARK, which is short the ARKK. So these all are moving. Now, the numbers, absolute numbers, are not so good. So it's more to put in the back of my head. I'm not sure I'm trading it based upon those numbers. Next thing I do is I look at the indices. So let's look at the spiders. I love trend lines, by the way. If you haven't watched me before, that'll probably be pretty obvious. Let me tell you the trend lines that we have here. We have the markets, which we know ran up for a long time and started selling off at the end of 2021. We've been in a downtrend. We've had one down leg, two down legs. We're in the third down leg now. I thought it was interesting that on all the major indices I was able to draw a trend line that connected things like the June low, the July low, the September low, and then we broke right through. That makes me nervous. The white here is the June highs, the yellow is the June lows. I've been talking for weeks that my target is a retest of those June lows. A failure there, I think, puts the 2020 highs before the bear market in play, and you can see where we are. We're at 385.56 Friday on the close. We're at about 360 on the June lows and about 330. So I hope we don't go down to the 2020 highs. Right now, I can't be bullish this market. We've broken down below support. To me, we're coming down here. We failed at the 200. We failed at the 50. To me, a retest down here is likely in the cards. Notice on a rough week, we see volume. On a good week, we don't. That's also bothersome. I could go through each one, but I'm not. It's all very similar patterns. Broke through here on the Qs, broke through on the diamonds, actually broke through on the IWM. Here is UVXY, and you can see it's off the bottom. It really hasn't done much. And the thing that's been the most bothersome is the strong dollar. It actually came down a little bit, or actually gapped up and finished flat on Friday. Now, dollar was flat. Maybe you're going to see something in gold, and we could see that gold, which is in a horrible bear market, gold actually was up 0.5%. Really no big deal. But think about gold here. It's below the 50. It's below the 200-day moving average. It's come off 193 to 155 just from this leg alone. It's got a long way to fight back. Now, silver is different. Silver took out the 50 and is stalling here. Silver's got perhaps industrial uses. Perhaps that's why it's behaving better. But I'm watching those, especially if the dollar moderates. Oil came down, broke through the 200. There's talk now about the U.S. redoing their strategic reserves and the current pricing. That'll firm up the market. We'll see if that happens. And Mr. Volatility here, natural gas, is broken down below the 50. Up here is the 10-year yield. We are below where we were in June, and we came down at the end of the week, which is a good thing, but it's still extremely high at 30.45. The weekly market simple timing that I follow, I look at two things. I look at the weekly candlesticks with a 30 a WMA that is 30 periods or 30 weeks. Now I also have the SMA in yellow, and I play around with them. Let's see, yellow's the SMA to see which I like better. But when we're prices below and the weekly bond goes red, prices below, weekly bond goes red. We are below, prices red, weekly bond goes red, price below, weekly bond go red. We are in sell signals in all the markets as far as I'm concerned. The major markets, spiders, Qs, Russell, and diamonds. And this is something I wrote weeks ago. Are we in the middle of our biggest leg down, and do we come and touch the January 2020 highs? Market theme, large caps are still in charge. We had a run where small cap looked better, but I think we're heading back up to large. And the other thing is values in charge. So I think this is more of a defensive posture. I like taking the S&P sectors and creating ratio charts versus the spider, just to sense which one's actually moving. And I had 4-star candidates on this weekend. Financials have picked up a lot. That's one. Industrial was strong. They've sold off. We'll see if they can come back. Technology is in the toilet. Healthcare has come up off the bottom. Discretionary remains strong. And utilities are probably the things closest to their 52-week highs. So that gives me a little bit of information. I jump into my bull scanner set, and I start with on heat map. And the first thing I said was, oh, for a lousy day in the markets, it wasn't that lousy. And one can see a lot of green. I mean, Tesla, Google, Microsoft, Costco, Micron, and the shocker is there it is. So UPS was down 4%. Oh my God, I'm glad I didn't stop this. FedEx was not down 4%. FedEx was down 21%. So this part was not updated when I looked at it before. So my comment still holds in that there's a lot of green here considering how negative the markets were. I am sorry about the last minute or so of confusion. All right, let's go to Sector Scanner. Sector Scanner shows me that everything is negative on daily, weekly, or monthly. This is not the S&P 500. It's not the S&P 1500. This is all the stocks that were available to wealth charts. You can see the number of stocks. I've already built my top-down and bottom-down list, so we're going to continue on. Wealth Scanner gives me a sense of what's working. This is a bullish scan. And again, I set it for a very short period of time. And when you see SQQQ as one of the leading things, and SQQ is one of these contra ETFs, meaning it goes up when the markets go down, that is a very bearish sign for the market. And so here we have a breaking out of an instrument that goes up. So we've got short the bonds, we got short the Qs, we got the dollar, here's silver, here's volatility, then energy comes in. And when you look at the numbers, all these things are too low to be meaningful to me. Now, if I looked at the bear side, just for discussion purposes, same thing, I'm just running it bearish. Notice how big the numbers are. Staples, short-term weakness, real estate, aerospace, technology, semiconductors, mining, industrials. So you could see the numbers on the negative ones are much higher than the numbers on the positive ones. That just tells me there's a bearish bearish influence to this market. Now, I'm not advocating a lot of longs here, but if I run my weekend review looking for reversals, let's just look at the few, because some of them actually look okay. Don't know why I'm getting all these things showing up that I thought I turned off. I played around with some of the free stuff in wealth charts. All right, IRM, Iron Mountain. I think they take junk from offices and store it or destroy it. Bear market. Here's, as Kramer used to say, I'll find you a bull market somewhere. Well, if you're looking for something that's actually performing well, with a pullback and a breakout on massive volume, with breakout volume momentum, strong relative strength in OBV, Iron Mountain looks interesting. BJ's, I think the lower cost places to buy stuff, doing well. You can see on the weekly how big of a run it's having in a soft market, and a pullback to support and a breakout on Friday. HLIT, I saw that on a few boards. Harmonic Inc., don't know anything about this company, but what's not to like? Massive volume, breaking out momentum on high volume, and you would have had the signal on Thursday that I use, and you could have gotten in early on the big move up on Friday. And then Twink, Hostess Foods. Yeah, you want to. I remember how many Twinkies I had growing up. Also in a nice move. So there are things out there that are positive, and perhaps HLIT and BJ and IRM are potential to the long side. But I got to tell you, I'm hard-pressed to want to go out and spend a lot of money. Look at Humana as another bullish play. Humana had great earnings. And even with a bad day on Friday, Humana was up over 0.5%. Now I can do the same thing on the bearish side and look at my weekend, make sure I get my weekend short review. And let's see what comes to the top here. AGCO. AJCO. Yeah, I don't know why I'm getting, well, I'm not even going to hesitate not even going to ask why I'm getting all these things. I'm just going to kill them. I bet I've got the wrong dashboard open. That's okay. All right. All right, so is this something that's shortable? Well, it just broke down below the 50. On the long term, it's downtrending. Okay. It had a breakdown on volume with momentum coming out of a squeeze. And remember, squeezes can end up with a big move up or down. Falling relative strength at OBV. I think that one could be interesting. Insurance have been strong, but here's a stock that is selling off after a big run up. This is Arthur J. Gallagher, AJG. And you can see it's broken down to the 50. It may bounce here, so I would wait and see, but a break below the 50, perhaps it's coming down to the 200. AL, Air Lease, stock in a nice uptrend up to the 200, broke down, failed to retest at the 50, broke down with a gap down on volume on Friday. Another potential short, APO, Applied Global Management, even nicer, breaking down below the 50. The point here is, notice what I did, and this is the power of scanners. I said I designed this scanner. Pick your price and your volume. I like things optionable. I don't want any bullish bars if I'm shorting it, or dots. I want at least one bearish dot, and I want the short-term trend to have reversed to bearish in the last 5 days. And I want that in the setting of a bearish, longer weekly chart. So these are the charts, and the beauty is each one of them looks interesting. Don't know about BYD, but here it is, broke down below the 50. What about CAR? Broke down below the 50. So if we are truly going down and testing, these might be interesting to look at. So this is how I do it. Now, the next question has to be, if the markets are going down and I'm not comfortable shorting or buying puts, or my IRA doesn't let me go short, is there anything I can do? And the answer is absolutely yes. I could drop out that weekend review and find my contra ETFs and just talk about these very quickly. SQQ already was something I mentioned. Why do I like SQQ? Because it goes up when the Q goes up. I can buy options on it. I could even buy it for my IRA. And you could see this thing is broken out. Now keep in mind, these are not investments. You are betting against the market. What does the market do on a long-term basis? The market goes up. That is not a bet that you want to hold forever. In fact, if you look at where this came from, came from far, far away. And it's not that it's dropped from the thousands or the hundreds. It's purely that there's been a lot of reverse splits, and that's only happens when your stock falls. So short term, if you think the Qs are going down, you can go long SQQ. What about short stock, the small stocks? If you think the small stocks are going down, you don't have to short anything. You can go long TZA. Probably would not let it get below the 200-day moving average. If you think the S&P is going down, you can buy things like SPXS, which is leveraged, I believe, 3 times. SDS, I think, is leveraged 2 times. Instruments that will go up when the market goes down. So let's summarize. And I apologize for my confusion on the FedEx and UPS. They were buried in the volume. First thing is, this is a tough market. We were down 5% last week. This is not a market to be all in. This is not a market to play with your retirement. This is a market you can nibble. You'll get moves up and down, but be careful. And again, don't go all in. Second thing is Fed meeting and results on Wednesday will move it. We might trade up into it after a 5% down week. I am concerned we're going to retest, and therefore I've continued to have cash. You can play longs and shorts. You play them small. You have stops. You don't be a hero. And if you want to protect some of your longs, one way may do it to buy the contras. Have an awesome week. And lastly, think about coming to South Florida in December. The weather's great. I promise you I'll do the best that I can. And if nothing else, you'll gain 5 pounds on me. Have a great weekend. Goodbye.